All right, we're just going to give a few seconds here for people to trickle in. I know that we've got people coming in from all over. People still calling Victor, trying to figure out how exactly to access this. So just come on in. You can introduce yourselves in the chat. We should be good to go. Under a minute here. Again, welcome everyone. Thanks for taking time out of your day, Wednesday afternoon. If you want to type in there what you trade, I'm sure people will be interested. If you're equities, if you're futures, options, if you're all of the above, none of the above, just starting out. A lot of you have seen me before. A lot of you see me a bunch of times. So why don't we get started here? So hello, welcome. Again, I want to say thank you for taking time out of your afternoon to join us. I know some of you it's later in the day. It's about 4:30 or so here on the West Coast. We're at 1:30. The market just closed. I'm Adrian Manz. For those of you who don't know me, most of you have been around me for a long time. I know we've got several hundred people here today. To take a look at this first hour trading stuff. And I can't tell you how happy I am that everybody decided to join us. As you know, this is sort of the first time we're going to do this kind of thing. Usually you see me live at the events. I like to travel. We like to travel. I like meeting people. I like having drinks with people and stuff afterwards. But there's been enough, I'm going to call it not really confusion, but enough perseverance on the part of some of the people who have been to see me and trying to sort of stay up to date with this stuff and figure it out, that I thought if we break this into a few sessions and focus on sort of the whole business instead of what we usually do at the trade shows, focus on everything that it takes to run a first hour trading business, then those of you who are already doing it can get a little bit of insight into what it is that maybe you need to polish up. We've got a bunch of folks here online today who are going to be going to the May boot camp. That's fantastic. Some of you who are getting ready to go to the May boot camp. So some of you have already signed up for the Income Trading Academy or already started taking the Income Trading Academy. Others are, getting ready to do all that legwork, all that homework before you come to the event. And some of you are just here because you want to do the first hour trading stuff, and that's great, right? And you want to learn about it and see what it is that we do. So let's dig in here, and let me tell you that, when I say we, I'm talking about my wife, Julie, and I. Let's see us there in the picture. That's us a few years ago, not all that long ago. We started trading together 27 years ago now. So we were in graduate school when we started this whole thing. And, when you can approach trading from a bunch of different ways. I can say people get into trading from a multitude of different professions, different backgrounds. And really, for us, this was a matter of, grad school. When we were working on MBA, PhD, trying to get to where we would have some data. And market data was readily available, and you need a bunch of numbers to crunch. And this stuff fascinated us. So we wanted to see, was there a way that we could get in front of this from a behavioral finance point of view. So we're both psychologists, organizational psychology, but that's pretty, it encompasses sort of everything. But we were also working, I was in the business department working on my master's in business administration. Peter Drucker was a big mentor and sat on committees for me and really gave me a sort of a guiding hand in what I wanted to do business-wise. And when we had developed our trading business, when we started trading, it was sort of around all that data. You can imagine you're collecting data, and once you're collecting data and you see that this stuff works, you want to try it. And once you try it, you do things like start trading with your student loan money, which, probably not the greatest idea in the world, but when you're a broke grad student, there's not all that much else. You're not going to pull a pile of gold out of the basement or something. So we did what we did, and right about the time that we were getting ready to graduate, Peter asked me, well, what are you going to do now that you've got your MBA, your PhD? And I said, I think I'm probably going to work with a Big Six consulting firm, work with McKinsey and Company, had been recruiting. And his comment was, well, don't you have a successful business already? Didn't you and Julie start a business while you were here in graduate school? And I said, yes. And his response was, well, then, take it from the top business consultant in the world. What you don't want to do is give up a successful business. So we decided that, we were going to try to do this. And the only thing that was going to be missing was the ability to teach, because that's really why you get a PhD is, you want to go out and you want to be able to teach afterwards. And in our case, this outlet that we have here, teaching people how to do this stuff at the expos, publishing things to periodicals. The stuff that I work on has been published time and again in just about every kind of a trade journal that you've ever seen. So it's been very good for us in terms of getting out in front of people and in terms of talking to people and providing some education for people that they really wanted. And I think that's made for an interesting transition from academia to doing this full time, which we've done for 25 years now, and then also with our ability to foster the business and foster what we do. So you can find stuff just written all about what we're doing in all of these trade magazines.
Hey, Adrian, I'm getting some comments that people need the volume raised. Hold on, you guys.
Hang on 1 second, guys, and we'll see about the volume.
This is the fun of live seminars.
Let's see here if we can raise the volume up a bit.
You got to blame the producer here, everybody.
So how do you guys feel about that? Is that better?
All right. Ramesh says that's good. Perfect. Great.
That's better.
Okay, guys.
Okay.
Sorry about that.
Well, sorry about that. Like I said, we're used to being live in person, not live on camera. So this is going to be a little bit of a... I'm surprised the whole thing's live to begin with. So given the number of things that usually go wrong when we try to do this kind of stuff. So, like I said, we published all these things I'm going to talk about are published over the years in tons of periodicals. You guys, most of you know my books. Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. That one sums up everything that I've done in terms of strategy over the years. It's currently out of stock. It's currently not in print. It's coming back next year. It was a bestseller for a very long time. It just needs a little facelift, needs a refresher. That was written around a baseball analogy. You're going to hear some of those analogies in what I talk about today. And then the rest of this stuff was different spins on what happened in Around the Horn. But today we're going to focus... Don't go out buying a book, because what we're going to do today is focus on what we do in the first hour of the trading day and how it is that we can profit right around the open. So for a lot of people, trading the open is very intimidating. So you've heard, over the years, there's been, all sorts of craziness put out there by people who are promoting different things and trying to, tell you how to trade. What I can tell you for sure is participating in the open. So as somebody who has been a manager in hedge funds and, somebody who's very actively involved in trading every day, participating in the open is a huge benefit when you're trying to build a trading business. And in fact, we still do the trades that carry on over the course of the day, but a lot of that stuff is just programmed up and runs on its own as the day goes on. Most of the time, what we focus on is we want to be done the first hour and a half of the trading day. Right? A lot of you have joined us in our first hour trading pit. You sort of look over our shoulder, you see what we're doing. Most important thing to 90% of the guys in there, right? So you're looking at the cohort group in there. Those guys are all people who have been through the boot camp over the years and have been trading professionally with us for a lot of years. And what you see each and every day is there's none of this stock junkie stuff going on, right? Nobody is focused on, gee, I just want to be here all day long and have something to do. Everybody's there for one thing and one thing only. They want to earn a living, or they want to make extra money in the first hour of the trading day. When that hour is over and done with, they want to go out and live sort of the lifestyle that Julie and I have led over the years. Everybody who knows me knows I'm out for a hike at 9 a.m. every day because we're on Pacific time. We live at the beach up against the canyon. I'm either hiking the canyon, hiking the beach. I spend time with my kid. We go skiing. We spend all sorts of time traveling and doing everything else. And it's because I think we've limited most of this active trading stuff that we do to that first hour, hour and a half of the day. And that's what I want to focus everybody out there on. It's a little bit of a different psychology than longer term trading for sure. It's a very different psychology than buying puts, selling puts, and being involved in just the option side of it. But I think you'll find this interesting, and I think that you're probably going to wind up getting a lot out of this, and hopefully you'll be able to trade some of this stuff yourself. So I've broken this down into the three most important areas, and you're going to hear from myself and from Julie. Julie will be on tomorrow, since we have sort of this introduction today to the whole thing. Strategy, discipline, psychology, right? And what I'm going to show you are the three strategies that we focus on most frequently around the open. We do other stuff, but this is our primary bread and butter kind of setup. And then I'm going to talk to you about what the discipline is behind it, and we're going to get into how you've got to be wired, right, where you are between your ears when it comes to actually taking these trades and surviving and becoming a thing that you want to be, whether it's a day trader for extra money, or it's a full-time trader, or even a fund manager. So when I say strategy, what I am talking about is you need to have, in my opinion, right, if you're going to trade stuff the way that we do it, you need an automated trade for the open. So I've got these things set up so that I've got something that happens on its own. It's automated right around the opening bell. I've got a super cap volatility band opening trade. That's the one that I do in Apple that a lot of you guys like to focus on, the Apple trade. And I've got the 2SD opening gap mean reversion trade, the one that I called Baltimore Chop. So those three trades are the thing that gets us in front of opportunity. Okay? And what I'm going to do over the course of today, tomorrow, and Friday is do one trade a day so that you guys can focus in on the technique, focus in on what it takes to do each one of these things. We're going to do a little bit of a deeper dive than we do at some of the shorter sessions at the live events, obviously. With that, I should also say I'd love it if you would join us in Orlando, Florida for the Money Show. That's coming up in February. Or at the Traders Expo in New York. If you're there, come find us, and we can talk some more. But what I'm going to talk about today primarily is this automated opening continuation trade. It forms sort of the basis for a lot of the style of trading that I do, and it applies to these other things that we're going to talk about as well. Okay, it gives you sort of a background and a backdrop of techniques and things that you should keep in mind. And once you have that down, then tomorrow we're going to look at what I think is sort of the most difficult trade, but what a lot of guys are gravitating to. That's my sort of an Apple a day thing where I'm doing these opening trades in Apple. A lot of guys are trying to make a living doing just that, and doing really well with it. And then on Friday we're going to do the 2SD thing, so we're going to get to that. All right, so let me tell you in terms of strategy, discipline, and psychology about the discipline a little bit. So obviously, right, our slogan has forever been plan the trade, trade the plan. And when I say plan the trade, what you're going to see is this is a function of the handicap that we have of being located on the West Coast in California. We get up at 5:30 in the morning to do our trades. So what I try to do is get all the precision that needs to be built into my trading built into it the night before. So I have very precise entries that are based on today's price action determining what I'm going to do tomorrow. I've got all my stop losses set up based on logical support and resistance violations. And when I say violation, right, that's something you have to keep in mind. A lot of guys who come to us, I taught a lot of people how to trade. Awful lot of people learn how to trade from us. And generally speaking, when they arrive, what Julie's noticed is even when they're setting stops, what they're really doing is setting targets. So think about this in terms of how often have you set up a trade, you get into the trade, you follow your trading plan, and when it hits your stop, that's the exact lowest place or highest place that it goes. The thing bounces, reverses, and goes all the way to your target right after it stopped you out. You know, that's awful. It's very, very frustrating. And that's because you didn't use a violation of the support and resistance level that you found. You used the support and resistance level. You used the spot that you thought it was going to bounce as the spot that you were going to get out. So when I say logical, what I mean is it's got to hit that area and it's got to break through. So you're going to see we use some wider stops than some people are very comfortable with, but look at the results. Look at what happens. It doesn't matter whether it's a wide stop or a narrow stop. If you're uncomfortable with the risk, and we'll talk about this in psychology, the correct thing to do is to narrow the amount of shares you're going to use, not reduce the stop loss, right? You just cut down the share size so that whatever the dollar amount that you're willing to lose is now not a problem, right? You're not going way beyond what your acceptable risk is, and your stop is based on a logical place to get out of a trade if it's violated that area. Then the other thing is we've got logical profit objectives based on key inflections. So lots of people over the years have come to me and said, well, you know, the lines you're drawing, aren't those really just inflection points? Aren't those just places that, you know, price is going to bump around a little bit? Well, I don't know. What I do know is we're in the business of predicting inflections. And when you start, you know, looking at this as, boy, man, he's got a dollar target, but, you know, there might be, in the case of this trade we're going to talk about today, the targets are frequently $1 or they're a pivot line. And I've had a lot of people say, you know, a lot of those wind up going more than $1. So, you know, I'd like to try to lock that in, but boy, you know, when I try to get more than $1 out of them, a lot of times I get my fingers burned. And that's because the market doesn't care how much you want to make. It doesn't care how much you want to make. It doesn't care how much you're willing to lose. What goes on in markets is that you're going to get to a place the price is going to logically inflect, and then it's decision time. And if the only decision you have to make is, I'm getting out here because that's what I planned, then you're going to have more successes than failures. If you start getting into the business of, well, I've got my dollar target, but now I'm going to trail my stop. Well, then how much are you going to trail it? Because if you trail it 10 cents, I guarantee you, you're just going to get out at 10 cents minus, less than $1. Dollar minus 10 cents. If you trail it at 20 cents, chances are it's going to bump you back out again. The only place you can really trail it with any confidence is down at the next level of support and resistance. And that's going to mess with your psychology, because you're going to look at this then and say, well, if I would have got out at my target, you know, I would have had more, and now I wound up coming down to my stop, you know, my trailing stop, and my reward to risk ratios are all messed up. Just stick to what you plan to do, and don't worry about going in and changing everything once you've started trading. Objective money management rules. Those of you who have been following me for a number of years, you know I plan everything. Everything's got a rule associated with it. The rules are pretty simple. There's only 3 of them involved in every trade, right? We've got an entry, then we've got a place that we're pulling things to break even, and then we've got a place that we're getting out at our target. Frequently, we're pulling a stop up to the 50% to target level. That's on the NYSE-based trades. But really, the most important thing is that once we planned our trade, we go and we trade the plan. We're going to enter only at the planned level. We're not going to chase. We're not going to go and try to find a better entry level, right? There's some advanced trades that we do at the boot camp that involve looking for reversion moves back into the range that hit a pivot line. But for the most part, 90% of what we do is get in exactly where we plan to get in. You're going to control slippage with order structure. A lot of you guys tell me you're doing market orders. A lot of you guys tell me you're trading for free because you're routing through, whatever broker it is has a route that will let you avoid commissions. That's okay, maybe if you're trading Apple, because the spreads are so tight. But you get into some of these other things like the trade we're going to talk about today, the expansion of range and volume trade. You toss a market order out, and the chances are you're going to get filled probably half of the way to the profit target, because that market maker, he's going to step away when he sees those orders coming. He's going to step back. He'll honor the first 100 shares or whatever he's quoted on the liquidity quote, but you've got a really good chance for a slip. So I use marketable limit orders. I'm going to show you how to set up a marketable limit order to control the slippage. You're going to be a lot happier, right? You might pay the $4 in commissions, depending on what route you use. I like to route straight to the exchange, so you're probably going to have to, if you want to direct your order, if you want to use a directed order as opposed to a non-directed order, you're probably going to pay the commission even when your broker's commissions are free. But if the slip is going to be 20 cents, right, and you're trading 100 shares, then that slippage just became a $20 commission. What happens if you're trading 1,000 shares? Now you pay $200 instead of $4. So bear that in mind when you're looking at how I structure orders. And just remember, if you're trading with a broker who allows for 0 commissions, there's some discretion that you can use as to when you want the 0 commissions to apply. So that, brokers got to make money. There's no two ways about it. So when they route you through their market maker, they're making money on the trade, or they would be out of business. And if you're going to do something that requires you to control the slippage, you'll set the order up the way that I'm going to show you to set it up. So the other thing that I would say is very important is that you automate your money management routine. So I use a piece of software called Realtic. You can use Excel to automate your money management, right? So that if you have rules for one of the trades that we do, you've got an entry, then 50% of the distance to the target, you move your stop up to the entry, 10 cents to the target, you move it to the 50% level. At the target, it takes you out. All that stuff can be automated via the spreadsheet. If you're using TradeStation, right, they've got easy language. You can just go in and automate it there. The whole purpose of automating it is really, once again, going to relate back to your psychology. And like I said, I train, so that, these boot camps that we do, those of you who are going or who have been, you guys know, it's 20 people and it's twice a year, and you all come with the same garbage, right? It's always the same stuff that's messing people up. And one of the main things is that when you're looking at the screen and you're watching things happen, you tend not to follow the money management rules as precisely as you would if you just put the stuff out there and let the machine take care of it. Because you start seeing things, oh, I've seen that before, and you convince yourself that there's a reason to second guess what you thought you should be doing. So last night, when you had all of your faculties and you were bright-eyed and bushy-tailed and you were putting together these setups, you had a really concrete plan. And first thing in the morning, after 4 cups of coffee, and you're still trying to wake up, you think you see something on the screen that warrants second guessing everything, so you go and you start pulling stops around and second guessing entries. And I would just say, don't do it. What you want is replicability. You want to be able to analyze your trading. So what you need to do is just get in there and automate as much of it as you can. And for goodness sakes, if you have a target on a trade, right, you always want to exit at the target. If you have a stop on the trade, you always want to exit at the stop. I know very, very few people who improve their results by trying to, shotgun these things or trying to move through them in a way other than what they planned. And finally, let's start talking about psychology. And when I say start, it's because this is a very, very deep topic, and we could probably do a whole 10-hour seminar on just the psychology of trading. But I was on the phone with one of you yesterday. This one of the boot camp alum, and this yesterday's conversation had a lot to do with probably one of the core principles that you're going to have to focus on, which is your relationship with money. And you need to know what money means to you before you go out there and start trading it. So everybody knows you should never trade, you should never have funds in a trading account that are subject to loss that you can't afford to lose. If it's going to make a difference in your life, if it's going to make a material difference in your existence to lose that money, make sure that it's not available for loss. So if you have a $30,000 trading account, some portion of that is going to be risk capital, and you should know that. I mean, you have to have $25,000 in a PDT account in order to be able to trade intraday, to get in, get out, get in, get out. But that doesn't mean $30,000 is your risk capital. At $30,000, you don't even have $30,000 of risk capital. You have $5,000 because you always have to maintain $25,000. But even people who are putting, I get people who call all the time and say, you know, I'm coming to the boot camp and I've got $200,000, $300,000 in an account. You know, what do you think I should risk? And I said, well, I don't know. What do you think you should risk? You're the most important. I barely know you. You're the most important arbiter of managing your relationship with risk that there ever is. And if you look at that money and you think, geez, you know, if I lose today, I don't have my house payment, I don't have my car payment, you've put yourself in a terrible position. And what I'll guarantee you is you'll second guess your trades and you'll wind up losing money. So always, always, always have your relationship with money in the back of your mind. And again, you need to go and adjust the number of shares you're trading, not your stop losses, not your targets. What you want to do is develop a very good trading plan, and then your psychology comes into play and says, how much money am I going to be comfortable having go away? How much money can I lose and not freak out about it and wind up losing sleep and all this other stuff? That's where you make the adjustment. Adjust the share size, get it down small enough so that it doesn't matter to you. Sharpen your skills. That's going to sharpen your psychology too. The next thing that you really have to consider is how much are you able to follow through? Because I've run across people who think that they are, I got a lot of engineers, awful lot of engineers work with us. I have hundreds of engineers who I have trained to do this stuff over the years, and you all think that you're going to re-engineer the process so that you know, everything is perfect, and then all of you wind up second guessing everything just like everybody else, right? So what you need to do is you need to take a good assessment of how often do I say I'm going to do something and then follow through and actually do it, because that's something you're going to have to work on. And that's one of the measures that we have. At the end of the whole seminar, we're going to have a little series of psychological inventories that you can take. They'll be anonymous. You can take them. We're going to collect a little data from them, not personal data, but we're just going to try. We're always trying to evaluate, right? We're researchers, so we like to sort of know what's going on with people. But one of the dimensions on one of the tests is how much do you follow through on what you do? Because in this business, it's very important that you don't do things like say, okay, my trading plan requires me to be there for the 6.5 hours that the market's open a day, so that's what I'm going to do. And then the next day you go do it and you say, I'm going to play golf. Because then what happens is you go play golf, you come back, you find out if you would have stayed the day, you would have made the money you thought you did. Instead, you lost money or something. Now you start second guessing your discipline, and now everything's out the window. So how well do you follow through on things? How good are you about you know, setting goals, about being you know, remaining optimistic and doing things the way that you said you were going to do them, and actually getting from point A to point B? You know, can you get the ball across the goal line is very, very important in this business. Your comfort with risk. This is another, you know, huge issue for a lot of traders, and this is something that we evaluate and try to figure out. Guys I know who have had a very hard time even after the boot camp, right? We always manage to get them to where they want to go, but sometimes it takes a while. You know, and some of you have been out here and sort of hung out with us in Los Angeles to talk through things. That's great. I encourage it, right? You want to come visit. You know, all you boot camp guys are welcome. And, you know, what we get to is that it's really your relationship with risk has a lot to do, just like your relationship with money, with how well you're going to be able to do when you're trading this stuff. So if you're very uncomfortable when you have a perception of risk, you're going to have a very hard time trading. So you need to go and change the perception that you have of what defines success and what defines failure, right? I always tell people, did you execute your plan the way you said you would? That's a success. Did you deviate from the plan? That's a failure. Has nothing to do with did the plan make money or lose money. Has to do with, are you doing the things you need to do to replicate over time? And then finally, How about your ability to deal with boredom? So most of you, I assume, are in or are coming to the first hour trading pit, or you're gonna sign up for. There's no sales pitch at this thing, all right? I'm just gonna give you this stuff. You're gonna look at it. You're gonna try to figure out if it's for you, and if it's for you, you'll sell yourself. I'm not trying to sell you anything at this. I want you to come and watch how we trade, and then tell me, right, whether or not it's for you. That's the ultimate way to figure out these things, not this whole, give us your credit card and good luck trying to cancel stuff. This is about you figuring out if it's the right fit. And your ability to deal with boredom is super, super important. I can't tell you how many traders find all sorts of trades that aren't there. I've got one guy, I'll name him because he said I could, good old John Conforti. You guys know him from the room. You know him from the boot camp. And on the Apple trade that we're going to talk about tomorrow, on a morning where, let's say Mark Bibbs, who's in the room, he's very successful trading Apple. He'll do one trade, maybe two. And John would tell us he's up, John would say things like, geez, I'm up $1,500, I'm up $2,000 first thing in the morning. And then by noon, he'd come back and say, I'm negative on the session. Well, why was he negative on the session? Because the 3 trades that we did, or the 4 trades that we did, were accompanied by 250 or 300 trades that he did. Why did he do it? Because he's bored, right? And people who are bored, they tend to fire off lots and lots of random stuff over the course of the day, especially if their relationship with risk happens to be that they enjoy gambling. So this is a very bad business to be in. If you're a gambler, you really need to separate yourself from that, and it's a bad business to be in if you have low frustration tolerance and you get bored very easily. Okay, so that's the backdrop that I want everybody to put behind this stuff for, as we go on here. But the first strategy that I want to talk to you about is what I call the Fastball XRV expansion of range and volume. So for those of you who know my stuff, you know what a fastball setup is, you know what the NYSE setup is that we do on this. We'll take a quick look at that trading plan in a second. But XRV is a little bit different. It relies on picking up some program trading that happened during the prior session. I do this via a dedicated data feed that goes and scrubs NASDAQ data and looks for evidence of market maker participation over the course of the session. I'm going to show you sort of what it's picking apart on the tape, and you can go and look for evidence of this kind of stuff as you're flipping through charts. Just takes a while to do it. But it's a very simple strategy once you really step back and just say, what's he doing? So first and foremost, we are looking for a breakout from either a pullback or a consolidation in a trend. So the pullback variety of this says you're going to go and look for a trade in the direction of the underlying trend, where the consolidation version of it, we would go in either direction, either long or short after consolidation. So in the pullback, what we're betting on is the pullback is just a ratio pullback or something. And now we're going to get this pattern that I'm going to show you. With a consolidation, it might be an accumulation or a distribution range, and we're going to play the breakout in either direction because, right, you don't know whether something's accumulating or distributing until after the fact. But it's very important to be sort of conscious of, market cyclicality and the fact that big moves can happen on the heels of those ranges. The widest range of the past 10 days. So we get the pullback, or we get the consolidation, and then you get the bar that breaks. And what you want to look for here is, did that bar make a wider move, peak to trough, right? High to low, low to high. Is the move more extreme than the move that's happened over the course of the past 10 sessions in any one of those bars? So that's your first criteria. Your second criteria is what you'd like to see is significant volume. So I say greater than average volume. The reality is you just don't want to see low volume. You want to see significant volume happen on the day that the breakout happens. As long as that's the case, you're good to go, but not lower volume than the prior sessions. And tomorrow, you're going to enter beyond the extreme of today's bar. So when you get this set up, right? If it opened low and closed high, if that's the breakout, you're going long. And you're going to go long beyond that extreme. So in the case of this Fastball XRV setup, this is going to be just a tick above for a long or a tick below for a short. That's because these are NASDAQ stocks, right? So my XRV setup's always on the NASDAQ. Very rarely do I have a NYSE security pop up on these things. There's a reason for that. They're very different animals. NYSE and NAS, totally different even today, right? So forget the days that Julie and I were walking around on the floor. The market has a personality that has just persevered over time. And even though a lot of the order flow that's routing through, NYSE is going through ARCA, that's an ECN. It's still not the same deal as when you're dealing with the NASDAQ stocks. So on the NYSE trades, we look for a 10-cent confirmation of the breakout. And on the NASDAQ, we're just going a tick above or a tick below. So for a short, the shorts would happen if, let's say there's a downtrend, a pullback to the trend line, then the bar opens in the high of the bar, closes in the low of the bar on the daily bar, right? Then the next day we would go and short a tick below. And out of the consolidations, like I said, if it's moving down and it consolidates, I'm going to show you some idealized examples of these things so that you can wrap your head around it. But you're always going to be going just a tick above or below for these entries. So here is the pullback version. This is an idealized chart. You're looking at daily bars. Each one of those bars represents 1 day of trading. So here's your pullback. It pulls back toward the direction of the trend line, and then you get this pop to the upside. On the around the horn trades, you have an extra level of digging that you need to do to make sure that you've got enough room on a daily chart up to supply for a target. But in this case, what I'm doing with this NASDAQ trade is I'm just looking to go long a penny or two above the high of that bar that created that expansion move. And the next day, I'm going to target $1 per share, or I'm going to target the next floor trader pivot line, whichever one comes first. There's good reason for that. I'll tell you, that's a bunch of data crunching, number crunching that we did on the NASDAQ trades. That tends to be where they revert. You guys who are going to try this XRV stuff out, you can go back and prove it to yourself. You can look at all the setups from the last 2 years and figure out how many times would I have extended more than $1 if I wouldn't have listened to Adrian. How many times would, an extra however many dollars come my way versus if I get out at $1 or I get out at the pivot, that's the best place to get out. That's usually the case. So that's the long side. Here's the short side. You've got to move down, pulls back, right? Then we get a break down, opened high, closed low, penny or two below the low of that bar is where we're going to go short the following session. Consolidation trades, very similar, right? You've got a trending move higher. It gets into this consolidation, starts trending sideways, could be 2 days, 3 days, anywhere up to probably about 10 days of data. And then we get the pop either up and out, or we get the pop down and out, even though it was an uptrend, right? In this case, it's a trend reversal. Or we've got to stop trending lower that consolidates. Widest range of the past 10 sessions. Nice volume, gets us down and out of the range. We're going to go short below there. Or a move to the downside, followed by a consolidation, pops up and out of the range, gets us in. Once we have the trade set up, we're going to go through, we're going to identify and confirm the opportunities. We're going to move from that daily chart down to a 5-minute chart and make sure we are really in tune with what's going on for that stock for that day. We're going to use conditional orders, and that's how we're going to bracket up our trades. And we're going to confirm that things are coming from the right direction, and we're going to make sure that the trade sets itself up for execution for the following morning. Because the way that I trade these is I set the trades up tonight. So the order entry that I'm going to show you is set up tonight for tomorrow morning, because I don't have time to do this on the open because of the trade that we're going to talk about tomorrow. So once the opening bell rings, what I want to have happen is that as long as this thing is within my allowable slippage, the trade is going to go and take care of itself. It's going to execute, it's going to money manage, and at the end of the day, one way or another, I'm going to know what happened. What I'm not going to do is go digging around to see how the trade is doing minute by minute and brood over this thing like a mother hen, right? Because that's poison and I know it. So once the price is moving in our direction, it's going to trigger us in. Bear that in mind, and let's take a look at one of these setups. This was from today. So those of you who are trading the Fastball XRVs on a daily basis, yesterday this was one of the trades. So we had 4 on that plan for today. So just so you know, it does about 10 points, $10 per share traded per month. That's the average. This month might be a little bit low. I had a terrible case of the flu, and I always say when you're not feeling well, it's not the best time to trade. So we were missing plans for the first week and a half of the month. That's okay, right? We're already picking up the pace, and the trades are piling on, and it's going really well. But you guys know last night we had 4. We had 1 trigger. We had 2 trigger. One of them wound up 10 cents to the target and then back down to break even. So that closed us out for the session. But this one here, big trend move to the upside. We saw this pullback in the trend, and the big MAR that moved to the upside here gave us the confirmation that we had the potential for a big follow-through day to day. Now again, I've got a proprietary data feed, so I'm going through and I'm picking that tape apart by machine to make sure, because a lot of these come up every day and you want to get the right ones. If you're doing it manually, you want to dig into this and find out that, in fact, we have a big move that perseveres over the entire day. There's price persistence, I call it, over the course of the session. Price is directional. There's very little pullback, and you can see that over the course of the day, you're getting an excursion from the volume weighted average price. So you can see here that there's 2 trends that I've identified for the session, and that those 2 trends then represent a couple different things as I'm doing my analytics. I've got a session VWAP there. So you can see that from the beginning of the day to the end of the day, my volume weighted average price falls relatively in the middle of that data. But that the second major move of the session, and this is called an anchored VWAP, and if you look at the line up there, the dotted line, what you see is that it's shorter than the session VWAP, and that's because it's from that trough that second arrow starts at, the lower arrow, and it measures through the end of the session. And that shows me what's been happening over the course of the day as buying has persisted and price has continued moving higher. It shows me the relationship of the buying pressure going into the close, right? Because we've got volume by price support there. Look at those huge prints going out at the end of the day. We've got volume by time support if you look at the bottom axis. So that if you guys don't have this stuff plotted, you want to plot this on your charts. It's either going to be volume profile or volume by price. It's in just about all software. Now, the real tick implementation here is a little bit different because it does an alg to figure out the importance of the volume that we're looking at. But you can see that on the right of the chart there, we have volume for each price that printed over the course of the day. At the bottom of the chart, you've got the traditional volume by time. That tells you a lot less. Right, volume by time just sort of shows you how much you're getting propped up over the course of the day. Volume by price, coupled with the VWAP, that gives you a better picture of what's happening. You want to pick this apart. You want to make sure that when you get that pattern, that you're seeing these big moves, big directional moves, either up or down, right? But a huge directional move, lots of volume by price support, and that the volume weighted average price is steadily just moving up as the volume by price is indicating and as the volume by time is indicating, and that you've got a really logical place to put your stop for tomorrow. So this morning, a lot of times we start these trades with pretty big stops. So the stop would have been almost down by that anchored VWAP under most circumstances. Today, that volume by price support level was the thing that cued us in that we could actually have a very tight stop on this, because in order for the stock to make a move that violates that volume by price level, right, it's going to have to chew through a ton of support, a ton of demand in order to get down below that. And if it does, it's probably going to start cascading back down to the range, so we don't want to be part of that. So now we plan our trade. So those of you who are going to want to try XRV, or those of you who are already on it, what this thing looks like. It's a fairly simple trading plan. At the bottom of the trading plan is a grid, and that gives you the symbols, and it tells you whether we're going to be long or short for the following session. So this was, again, today's plan. You can see there were 4 symbols on the plan, and the direction was long. So then really the only thing you have to do, and again, there's a video there that shows you exactly how I trade this thing, but once you have the direction and it's long, you know that if you're entering a tick above the high of the day, your target is going to be either $1 or it's going to be that resistance 1 level, whichever one comes first. There's going to be an inflection there, I can guarantee you. 3 times out of 10 we're wrong, and it keeps going. 7 times out of 10, if it hits it, it's going to reverse, and you've got 2 years worth of data that you can look back on, maybe more. There might be 2.5 years of data there now that you can look back on, and all you engineers can prove it to yourself. Right? You're better off honoring those levels than you are trying to monkey with it. The statistic plays out over time. So once I've got this plan in motion, what I'm doing with it is I'm automating the trade. So what you're looking at here is the way that I set up my bracket order for the next day. And what you have there is a conditional order. And if you look closely at how I've got this structured, at the top you can see it's a price/time trigger. So I don't want this thing to trigger me into this position in the pre-market. So what I'm going to do is I'm going to say, if the last price is less than or equal to $77.08, right? So it's within my allowable slippage, because I want to get in anywhere between 76.98 and 77.08. And I want to do it once the market opened and no later than about an hour before the market closes, because it's not going to have time to develop at that point. Practically speaking, these automated trades, it's pretty much the first hour, hour and a half of the trading session. Sometimes I'll leave them open for 2 hours, and then if they haven't gone, I just cancel them. So it's very rare that we wind up trading these later in the session. But you can see there that you can confine it to the normal hours, because a lot of order routes will not take a day order and fill it only during the day, right? A day order is considered the pre-market plus the day, and a day plus order is what's keeping you out of the aftermarket. So it's very handy to go and just bracket this thing up so that you've got the initiation time and an expiration time on it. And then you can see down here, as opposed to going and putting out a market order, what I'm doing is saying, hey, look, this has to be below the worst price I'm willing to accept, which is 77.08, right? There's a stop limit order. The stop price at $76.98, that's the price that I want to have trigger me into the trade. That's where I want the trade to go live. 77.08, that's the worst price I'm willing to accept. And sometimes it feels like they're going to go, they're going to go without you, you're going to miss it. But the reality is, if it gets through your price, if it gets through your threshold for slippage, usually it winds up wiggling back, and it'll get you in with a good fill, as opposed to getting you in 20, 30, even 50% to the profit target sometimes. So you want to keep focused on some good trading habits. Market order is never really going to be the best way to go. You can still control your commissions, even with TradeStation or Schwab or that kind of a thing, by just saying it's a stop limit order and then not routing the way that I did to NASDAQ. Just route it through your order, your broker's smart route, and let them fill it when price comes back in. You won't get filled as fast, but you also won't pay $20 in commission or $20 in slippage. All right, then the next leg of this is, I need to go and I need to set up an order trigger so that it gets me out of the trade if I got into the trade. And the way that you do this in Realtick, it's going to be a little bit different than TradeStation, a little bit different than Schwab. In Realtick, if I do this whole thing as a bracket order, I can carry it out automatically all the way through. The problem is, once I place the trade, my margin's impounded and I don't have unlimited money to trade with. I need the money for other trades. So if I have 4 of these things out there and it's impounding all that margin, I've got trading capital that's gone, right? Even though no trade is placed. If I use conditional orders, these orders only go live if they meet the condition, and then I need to tell it what to do once the condition is met. So in this case, there's an order trigger, and it says that if that first order went live and filled, then here's what I want to have happen. I want you to go and place a new order that takes into consideration, A, did I get filled? B, how much of the order got filled, right? And then goes and says, get me out for, in this case, a profit at a limit of $77.98. That's $1, right? So that's the dollar. The dollar is from where the threshold for the entry was, not however much you got in with and got slipped, right? You got 6 cents of slippage, 8 cents, 10 cents of slippage, doesn't matter. You're still going to get out at that dollar excursion or at that pivot. Always going to exit the trades with a limit order, right? So you enter with a stop limit, you exit with a limit, or you exit with a stop market for a loss, right? So the only time that you would use a market order is if price is going against you and you're away from your machine. So if you're at your machine, a better practice is to control the slippage even on the exit, right? Because the market orders, they tend to just back off and let that market come to them, right? And you're going to do the same thing here. It's just an order trigger. If that first order filled, use the trade value, use the amount of shares that I got filled on the way in. That's how much you're going to get me out for. If it didn't fill, delete the dependent order. You know, for goodness sakes, we don't want to get shorted into the market if a price gets hit. We want to make sure that what this order does is it cleans up the position that's already there. And in this case, that position is going to be a stop market to get me out. The stop here was, I believe, $76.60, right? So that was right below that threshold that we had seen the day before in the data. Here's what this looked like over the course of the session today. You can see our entry was violated right after the first bar of trading, or during the first bar of trading, I should say, I'm sorry. Got us in, it came up from below, entry triggers you in. Look at our target, right? So there's the dollar target. Could you have extended it? You could have extended a little bit, but look what happens after the dollar. So once you hit the target, you get the reversion back into the range. This thing goes out of the day, does nothing for the rest of the session. It is precisely what we expected to have happen. And look at that volume by price support from the prior session. It was right where we expected it to be. So if you looked at the previous slide, right, if you go back and you review this in the recording, and you're trying to figure out, you know, how this all fit together, look at that volume by price number, look at the way price settled in on top of it. Again, you want to make sure it violates the level, right? You want to put your stop down below there. Make sure that it has to actually go through. You're not looking to get caught in the bounce. So now, let's look at another pet project here of ours, and that's getting into people's trader psychology. And we talk trader psychology with a lot of you. I think we're going to go just a little bit over the hour. We're probably going to go about 10 minutes extra, and then we'll take questions, maybe a little less than 10 minutes. I might be able to pull this off on time. Trader psychology is you know, we're psychologists, so, you know, what we can tell you from personal experience is, you know, we deal with our own demons, and you're going to see it when you're digging through my trading plans. So if you're taking trials to the site, or you're coming in and poking around, looking around, what you're going to see is there's data on every single trade all the way back to 2006 that's posted there. Every setup, every spreadsheet that shows what happened with the setups, right? We take all the data in, and we want to know what's happening with our data all the time. So that's how Julie and I manage to stay on top of this stuff and not lose our minds. Because for us, it's important to know that the discipline is helping us get from point A to point B. You're going to see that everything that we do has a lot of precision. And that's because precision builds confidence. So if you look at my around the horn trading plan, now this is a NYSE plan, right? This New York Stock Exchange listed securities. This is different from the NASDAQ stuff. It's got a different set of rules that go with it. We're not going to go over those here today. If you want to look through it, you're more than welcome to. We can set you up. But if you take a look here on the trading plan at the bottom, you can see here, this was Cardinal Health. It was a line drive setup. It was set up for today. There's another one, hit our profit objective. Line drive is sort of a fastball that also includes a gap. There's a gap and go yesterday. The position from the daily chart was a long, right? And you can see here how precise the plan is. The entry, $52.56. The stop, $52.06. The initial target, $53.24. The ratio on the trade, I stand to make $1.36 for every dollar I stand to lose. On the NYSE trades, we follow that. 52.90 is 50% of the distance to the target. So if it gets 52.90, In this case, I'm pulling my stop to break even. It goes from 52.06, the stop goes to 52.56. If I get 10 cents to the target, the stop moves from break even to that 50% level. And all the while, we've got an eye on all those pivot lines there because we know that's going to be where support and resistance happens. And since this is a long, we've got an eye on that 51.95 level because all you boot camp guys know we're looking for that inflection to wind up taking us back up into the range for the current session. So be precise. Don't micromanage your trades. Right? If you're going to sweat every tick, if you're watching every tick, you're going to second guess your planning. You don't ever want to change course midstream, right? Because that's going to erode your confidence. Once you start second guessing and you start changing your plan as the day goes on, conversation I had yesterday was pleasant, but I really felt for you if you're here today. It's very easy to get wrapped up in looking at what's happening and seeing something happen that happened when you took a loss. And then thinking, oh my God, I'm going to wind up taking a loss again. And then you pull off a trade. You made 10 cents, 15 cents, hooray. And then you see it go to the profit target, boo, right? It's always the same kind of an outcome. You just don't want to do it. You want to keep your eye off the P&L. I encourage all of our traders to not have a P&L on the screen, right? You adjust your share size ahead of time so that you're going to take care of yourself in terms of risk. And you don't look at a profit and loss over the course of the session, because I can guarantee you that if you do, you're going to start fiddling with that trade and you're going to change what you plan to do, and the disaster is in the making then. I don't know what you're going to be doing a couple of years from now, but it's probably not going to be trading. So you want to avoid, like I said, this micromanaging thing and focusing on the profits and focusing on the numbers constantly. What tends to happen psychologically is it feels really, really good to win, and it feels bad to lose. And a lot of you go and you take smaller and smaller gains because it's very nice and it's reinforcing to take a gain. I got to win, versus taking the loss where you start not taking your losses, and then you wind up with portfolios that are, I had one guy at a boot camp tell us that, prior to coming, he had a portfolio of, in his retirement account that was all of his intraday trading losers compiled in one place. And I said, well, I guess you'd call that a portfolio, wouldn't you? Yeah, and we had a laugh about it, but it's something that happens to quite a few people. Avoid doing it, right? Don't look at the numbers over the course of the day. Stick to your guns and let these trades take care of themselves. Because again, as I said before, you've got to take measure of your trading by whether or not you executed your trading plans the way that you intended to execute them, not by whether you made or lost money. Julie famously got up at a conference that I spoke at and said to 1,000 people in the audience who were asking about what do you do with losers? What do you do with losers? Julie got up and said, I'm going to take the mystery out of all of this for you. You're going to lose money. It's going to happen. You're going to have losses in trading. There's just no two ways about it. And that particular conference was in London, and that was a whole different kind of a trading environment, right? They're trading contracts for, not contracts for difference. They're trading spread betting, right? Is their contract for difference, and it's the same problems, the same psychology gets to people all over the world, just the same way that it does here. So I like to tell people, there's no good days, no bad days. There's just days. Okay, you got to step up to the plate. The around the horn analogy, the sports analogy really amounts to the same thing in golf, in tennis, in anything that you're doing, right? It's a very famous baseball analogy that every time you step up to the plate, you have to have, it's got to be a blank slate. You can't think about the time you struck out. You can't think about the time you hit a home run. You just have to get out there, grind it out, do it again. Just do the same thing that you always do. Work on your skills as a trader, and the money's going to follow. So, that's today's take on psychology. Julie is going to give you a deeper dive in this whole area tomorrow. I think I'm coming up on the hour. I think I'm doing pretty good here as we get to the point that we can take some questions. Let me just tell you very quickly about a special offer for you today. As I said, it's no credit card, no money, no nothing. What I just want to say is, if you liked this stuff today, if you'd like to try this particular trading service, you can. And all you have to do is text XRV to 310-299-9148. What that's going to do is it's going to come back and say, okay, what's your email address? What's your first name? It's going to put you on the distribution list for the trading plans, for the XRV plan. And then what you're going to get is a text later that says your plan is ready. It's going to give you your username and password and everything to get onto the site and get tomorrow's plan. You can try it. You're going to let us know whether or not you liked it. We'll give you a call. It'll give you the number. I think it's 584-6490. Is that it? Yeah. 584-6490. 310-584-6490. It's going to ask you, go ahead and put that in your contact list, label it Trader Insight, because I know you get a phone call from a number you don't know. Everybody thinks it's spam, and they're gonna block the call, or they're not gonna take the call. It's just gonna be me calling, or Julie, or Victor, to make sure that the trades are going good. You understand what you're doing with them. See if you have any questions about them, need help navigating the site, whatever. We'll try to give you a quick call over the course of the next week, and hopefully, if you try this thing out, you're gonna see whether or not it's for you, because it's very important, right? That psychology matches your psychology. We want a good fit between you and whatever it is that you're trading. During the time that you're trialing it, please don't trade it with real money. Just paper trade it. Trade tiny little shares to see what your fills are like. Trade 10 shares if you want to try it out, or 50 or whatever. But don't put yourself in front of a bunch of risk because you don't understand how something works. Give yourself a chance to take a look at it, really dive into it, figure out if it works for you, and then and only then can you make the decision about whether or not this is something that you would like to do. So with that, I'm going to open it up for questions and see if you guys have anything that you want to pop in here for me. I will be happy to have a look.
Do you want me to relate the questions?
Yes.
Okay, let's have a look here.
That's the lovely Julie in the background there.
And the Roz Doyle to his Fraser Crane.
That's Roz to my Fraser. There you go.
Okay, let's get your face up in here. There we go. Oh, hold on. Okay, so let me just give him a question, then I'll get him up over there. We have Ron Zimmerman was in the house.
Oh, nice.
Okay, you guys, do you have any questions? It is being recorded. You are going to be sent a recording of this. Certainly, if you register for the text, that's going to be happening. I know somebody needs to know something. Anyone? Anyone? It looks like you explained everything.
Well, I did a marvelous job explaining everything. I guess we don't have questions here. I think somebody just typed something in there, but I don't know if it was a question or not. But all that being said, the other thing is, if you have questions about what we talked about today, and you don't think of them right now, and you want to get a hold of me later, then the other thing that you can do is just take down this number. It's 310-804-2248. That's my cell phone number. All I ask is if you have questions, send me a text that just says, hey, I've got a question about what you talked about. When can we talk? And then I really prefer to just talk on the phone. I don't like, the thumbs on the phone for an hour aren't really that great for me. But I'm happy to talk to you guys, and I'm happy to explain anything that you have questions about in more detail, especially once you've looked at the XRV trading plan for the next couple of days. Like I said, don't forget to text your information, or we've got most of your phone numbers already. Obviously, you guys have been receiving texts and things from us about this seminar and about whatever trading plans you're using anyway. But the only way that we know that you want to try this in particular is if you send the text that says XRV in. All right, so nothing?
No, lots of good people wishing you well.
All right, thank you. So, with all that being said, tomorrow is session 2. Same time, same place, different channel. So I'm going to send you a link to session 2. These links are only good for the session that we had today. Tomorrow's session is going to be trading 2 standard deviation opening gap volatility reversions. That's the trade that I call Baltimore Chop. It put me on the map. It made me a, well, maybe not a household name, right? I saw myself listed somewhere the other day as other public figure. So whatever that means in terms of 20 years of my life, that's, I'm other public figure. But that one is going to be the second trade of the day. It starts 5 minutes into the session, is the first time that there's a possibility for a position. We're going to do that tomorrow, and then we'll do the Apple, the volatility band one on Friday, and that's the opening trade. But I think that the 2SD reversion trade is something that will be real interesting for you guys tomorrow. Makes sense in terms of the support and resistance stuff that we talked about today, and I think you guys are going to enjoy it. All right, so with that, right, even without Tracy here, with the sign up in the door telling me I've gone over my time. So I'm 5 minutes over, but I hope you guys will forgive me, and I will see you tomorrow for the second part of our seminar. Thanks for joining us.
All right, thanks everybody. We'll see you tomorrow.